How to effectively use different time frames in trading. Multi-time frame trading analysis is one of the most important things one should be doing before taking any trade. This analysis is one of the simplest tools of technical analysis that will help you in reducing loss from your trades. One should take multi-time frame trading analysis to identify trading opportunities. A higher time frame is used to find the overall market direction, and a lower time frame is used to find an entry for the trade. The multiple time frame analysis can be used for counter-trend trading. What multi-time frame trading you should be tracking? The general rule is that longer the time frame, the more reliable signals are. As we reduce the time frames, the charts may give false signals. Ideally, traders should use a long time frame to define the trend of the stocks they are trading. Once the trend is defined, then the traders can use any time frame in which they prefer to identify the intermediate trend and a faster time frame to identify the short-term trend. Swing trader who focuses on daily charts can use weekly charts to identify the primary trend and 60-minute charts for identifying the short-term trend. The day trader can use 60 minutes chart to identify the primary trend and 5-minute chart to identify the short-term trend. Positional trader can focus on weekly charts, use monthly charts to identify the primary trend and daily charts to identify the entries and exits. Here are a few entry principles for this strategy. One should define what their signal chart is. For swing traders, this will be a daily chart, and for day traders, it will be a smaller time frame like 2, 5, 10, 15 minutes chart. One should add a higher time frame chart, that is either than your signal chart. One should trade their signal chart as before, but also remember to trade in the direction of the swings on that higher time frame chart. Benefits of multi-time frame trading analysis. The trend may appear differently in the time frame which you're looking for than the longer-term trend. Key levels of support and resistance may be there near your trade, but this cannot be seen in the time frame on which you are trading. You may have taken a great trade on a shorter time frame and achieve your target, but did not realize that if you have taken a longer time frame, then you might have earned more profit. You can make precise entry points shorter time frames than longer time frames. Multiple time frame analysis techniques for day traders. Day traders typically have the whole day to monitor charts and therefore can trade with really small time frames. This range anywhere from a 1 minute to the 15 minute to the 1 hour time frame. Day traders that identify their trade setups on the 1 hour time frame can then zoom into the 15-minute time frame to spot ideal market entries. Day traders can look at the 1 hour chart to establish the trend. Price trades predominantly above the 200 MA and is moving upwards, hence the long trading bias. Day traders can then zoom into the 15-minute chart to spot ideal entries. Day traders can then zoom into the 4-hour chart to spot ideal entries. The 15-minute chart allows day traders to get a closer look at how the price is evolving in the lower time frame. The uptrend is also apparent on the 15-minute chart, which confirms the upward bias. The two black arrows point towards the contracting Bollinger Band, which often precedes an increase in volatility. Multiple time frame analysis techniques for swing traders. Swing traders tend to have significantly less time to spend monitoring charts when compared to day traders, perhaps 1 hour or less. Thus, swing traders will look to the daily chart for the overall trend and then zoom into the 4-hour chart to spot entries. Trend time frame, daily chart. Entry time frame, 4-hour chart. The daily time frame on euro to pound sterling allows traders to spot the downtrend, but where is the ideal entry into the market? Zooming into the 4-hour time frame sheds more light on this. Zooming into the 4-hour chart, traders can look for short signals. Note the upper and lower channel lines are now faint dotted lines to keep the chart clean. After a failed breakout, price drops back within the trading range. Points to note. One should take multi-time frame trading analysis to identify trading opportunities. A higher time frame is used to find the overall market direction, and a lower time frame is used to find an entry for the trade. The multiple time frame analysis can be used for counter-trend trading. Using multiple time frame analysis helps in combining the benefits of reliability of a higher time frame, and also reduces the risk of a lower time frame.